Hello, and welcome to episode 16 of the Life and Finances Together podcast. We want to thank our audience members who have liked and subscribed and encourage you to make that click today if you haven't already. Today, our financial professionals, Roger David and Jake Reinvelt, will be talking about a fundamental aspect of financial planning, income in retirement. You'll hear them explain the importance of creating your personal cash flow, which is different from a budget, define the various options you have, how to balance that income with your investments to achieve your retirement goals, and even find a way to be tax efficient. I'm excited to hear more, so let's get started. Guys?
Here we are talking about one of the major components of financial planning, and it's all about cash flow, right? Jake and I say that all the time. It's about cash flow. Today we're going to kind of look at the income related to cash flow. But the first thing you need to do is do your cash flow.
Yeah,
right?
Exactly.
We need to figure out what you're spending, what are the mandatory things, right? The things that are non-discretionary, and what are the things that are discretionary. So, I mean, when you're looking at this, you really need to do a detailed cash flow. A goal-based financial plan just is not going to cut it. Mm-hmm. There's just too many things going on. And the other part of it too is that is just a wonderful exercise for anybody to go through. You're going to see where you're spending your money today. And Jake, we don't put people on a budget. It's not what we do. We just want to know where you're spending. And we kind of joke around about it because when you get into the interactions with the client, it's almost like a confession, right? And then the other thing too is that the other spouse didn't know what was going on. Those are interesting meetings. Those are a lot of fun.
Yeah,
right?
A lot of that revolves around Amazon.
Yeah, it does, right? And again, Jake and I also, on the side are marriage counselors, so I just want to let you know about that too. So, but it's not really what it is. It's just a tool. It's a way of taking a look at where your value set is, what's important to you. And it sounds terrible, or maybe it doesn't, but where you spend your money tells a lot about what's important to you. What do you value? So once you have that in place, now you got to start looking at, what are the income streams? Where am I going to get the money to pay for everything, right?
Yeah, exactly. So first and foremost, you need to know what your spending budget is, right? And from that point, now you have to coordinate the different income sources that you may have in retirement to figure out, okay, what's the most ideally tax efficient way to cover these things? So if you've got a certain spending need that we've defined, there's different income sources that you need to account for. Social Security is a big one that most people qualify for. Not as many nowadays, but some people still have pension plans, and Roger will talk about some of the intricacies of pension plans as well as Social Security. But it's also if maybe you have some rental income, or if you semi-retire and you plan to earn some additional income in retirement. There's a lot of different factors that come into all these, but ultimately what we're trying to determine is to meet your living expense need, what do we need to withdraw from savings, right? That's the biggest thing for we as advisors and portfolio managers. We need to know what your withdrawal need is. And we're going to try to coordinate those withdrawals, and we'll talk about that a little bit later in the podcast about tax efficiently. But the biggest thing that we always try to maintain is an amount of cash inside of those portfolios for the dedicated withdrawal needs. Somewhere between 6 to 12 months, an amount where we can keep the withdrawal going, especially in bad market years, but also not too much cash so that we're causing a drag on portfolio performance. It's a really delicate balance. It's a delicate dance that we have to do, but we need to make sure that we're maintaining the cash inside of client accounts so that we can keep the withdrawal going.
Yeah, I mean, one of the biggest mistakes that we can make is ignoring where we're going to get this income from, right? I mean, that's just the biggest challenge that we have, especially in retirement. So, I mean, a lot of folks will just say, hey, I want to take all of my liquid savings out of the bank, and I'm not going to pay any taxes because that's savings that you've already paid taxes on. So they say, hey, for the first 3 to 5 years, I'm going to withdraw everything I've got in my liquid savings at the bank, and I'm not going to pay any taxes. And it's going to make sure that I maybe get my nice discount or my subsidy from the marketplace on my health insurance, right? Your health insurance that you have to buy pre-Medicare before you become eligible for Medicare. Well, that's not necessarily the case.
Yeah.
I mean, you can still take taxable withdrawals maybe out of an IRA and coordinate those withdrawals from the money that you have sitting in savings at the bank that you already paid taxes on and still keep you in an income level that will still allow you to receive benefits from the marketplace on your health insurance and keep you in a lower bracket too. So, I mean, it's a matter of looking at it, not just blindly saying, this is what I'm going to do because maybe I read it in an article somewhere, or I just know I'm not going to pay any taxes. There's ways, again, to minimize the taxes and still reap the benefits as it relates to health care and keeping it in just a lower tax bracket. I mean, that's a big thing.
Yeah.
So, Jake had mentioned too, when you're looking at different income sources, there's Social Security, but there's also pensions. And those things have kind of gone by the wayside, right? So many companies have terminated their pension plans, right? The payment after you retire that you receive every single month for you and for your spouse's lifetime, that's guaranteed throughout your lifetime. Well, a lot of companies have gotten rid of those things. But if you still have one, most likely what's going to happen, the company's going to come to you and say, we'd like to give you a big lump sum.
Yeah.
Right? Here's a big lump sum payout. Well, the key there is to understand, is that lump sum that they're giving you, is it enough? Is it enough? And you need to do what we call a net present value calculation. We're not going to get into all the details in that, but you need to do the analysis to make sure the lump sum that they're offering you, and it's going to look pretty awesome because it's usually a six-figure number and people get all excited. But what's the rate of return that you're going to have to earn on that lump sum to make sure that you replace those income streams they're guaranteeing, right? And when you're kind of comparing apples to apples, the rate of return you should be using is probably kind of a low one because that would be more along the lines of a guaranteed rate of return, right? Because you were getting a guaranteed income stream. So if you're working with somebody and they say, well, hey, we can take that lump sum and we can make 5, 6, 7, 8%, those rates of return require some risk. It's not a foregone conclusion that it's going to be guaranteed like the payments you were going to receive.
Yeah, exactly. So that's why a pension, after you do that calculation, oftentimes it does make sense to take the payments from the company, right? Take those guaranteed income streams because it is a guaranteed income stream for the rest of your life and or your spouse's life. So that's something that we can always factor into what your withdrawal needs are going to be in retirement. The other one is Social Security.
Right.
And the timing of when you take it. Should I take it early? Should I take it late? What are some other factors that you need to think about when you're deciding when to take your Social Security?
Yeah, well, when we're doing the analysis all the time and all of the financial plans, we're looking at this break even, this thing called this break even. So Jake and I get the question all the time, or we actually get some statements once in a while too. I'm 62, I'm taking my money. I'll work my whole life. I'm going to get my money before Social Security is belly up. Maybe you've said that, right? I mean, a lot of our clients will say that. But you're looking at this, it's different. Now, we have some general rule of thumbs that we use in calculations and examples when we're doing our general Social Security and Medicare presentations, out in the general public. But as a general rule of thumb, right? So here's kind of the break even. Everybody's break even is going to be different. You should be running that in your financial plan. But as a general rule of thumb, do I take Social Security early at 62? Well, there's one thing in the general examples that we get from Social Security that you're going to have to promise me and Jake. If you take it early, right, the best thing is that you die before 78 and a half. Because if you live longer than that, you should have delayed or you should have waited until your full retirement age to take it, right? If you delay taking it until age 70 and you earn some additional retirement credits, right? Well, there's another thing you got to promise Jake and I. You got to live past 83 and a half years old. If you live past 83 and a half years old, right, good job. You did a good thing, right? You delayed, and now you got this larger benefit that continues through this life duration longer than 83 and a half years old. So what's the key thing? What do we need to know?
When you're going to die.
Yeah, that's what you got to know. That's what we're all trying to figure out, and none of us have that answer. If we had that answer, it'd be a heck of a lot easier. I don't know if I'd even want to really know that answer. I'm good with guessing, right? So, again, when you're looking at Social Security, there's other things, too, that you got to consider whether you should take it or whether you should, and that's some income thresholds or earned income thresholds.
Yeah, exactly. This is all about the coordination of these income sources. If you're going to semi-retire and you're going to earn income above a certain earning threshold, and that is earned income, so your pension income does not count towards this calculation, right? But if you're going to earn income and you're going to earn that income before you reach your full retirement age, and that is primarily for most people nowadays age 67, you'll see what yours is right on your Social Security statement. If you're going to earn income before 67 or your full retirement age and take your Social Security before that point, your benefit may be reduced. The threshold that changes every year, it's right around 23 or 24,000 heading into
24 this year,
2025. Yeah, 24,000. If you know that you're going to earn more than that, even if you consider it a part-time job, if you know you're going to earn more than that, it behooves you to delay your Social Security because you don't want your benefit to be not only taxable but also reduced.
Right.
So you have to coordinate those things, and that's where ultimately, when we're determining what your income sources are, we're going to figure out what makes sense to take. When are you going to start taking your pension if you haven't? When are you going to take your Social Security? And what we had mentioned earlier was when it comes to taking withdrawals from your retirement savings, is try to do it in the most tax efficient way possible, right? And that's where we call it filling up the tax bracket, where we're going to look at the current tax law and take IRA distributions that will maybe all be taxed at 10 or 12% income tax, and then look at other income sources for the rest of it, whether it be like a trust account, a non-qualified savings account, a cash account at the bank, so that we can have a little bit more control over those taxes.
Yeah, the other part of it too is when you're looking at what happens with maybe your Medicare premiums.
Yeah, exactly.
Given the level of income that you have. So this is, again, it may not apply to everybody, but coordinating these income streams in certain years, especially if you anticipate you're going to have a major windfall, I don't know whether it's delayed vacation pay or whatever it may be, if it's taxable income, it can affect what you pay in premium on your Medicare Part B and Part D. So what do you do? Well, if you can at all, maybe you coordinate how you receive or when you receive that income. Do you have to take it all in 1 year? Or can maybe you spread it over a 2 to 3 year period, which then protects what? It protects you being able to pay a lower premium on your Medicare. Mm-hmm. So, I mean, one of the other things too that affects this is that people go blindly into doing Roth conversions. And when you do Roth conversions, that's taxable income. Mm-hmm. And you know what happens then? Your premium on Medicare may go up in that year. So you love it because what are you earning a tax-free, you're creating a tax-free asset, right? Mm-hmm. But at the same time, what are you doing? Well, you're increasing your Medicare premium. And how it works is that they're not going to catch up with you immediately. So there's always like a 2 year delay. Mm-hmm. So if you're in 2025 and you look at your premium on your Medicare Part B and D and you say, hey, what happened? It went up from last year, and maybe you had a big windfall in 2023. Right? So there's always that little bit of a delay. So you're going to want to make sure that you coordinate those things too. Looking at everything. Gosh, there's so many moving pieces on this thing that you want to make sure that the other thing that you're doing is you're looking at it every single year. It's what Jake and I call a game day decision, right? Every year we're going back and saying, hey, this is what we did last year in 24, but this is what we need to do in 25.
Yep.
Making sure that you're looking at that.
Exactly.
And there's also these things that when you get a little bit older, around 73 years of age, maybe even 75 for some folks, you got to start taking these things called RMDs, required minimum distributions, right? Mm-hmm.
Yeah.
Those are tough.
Yeah. I mean, we can do all this planning that we talked about in the majority of this podcast, figure out exactly what our client needs to spend, what they need to withdraw, and then they turn 73 or 75, and the government tells them what they have to take out, right? The IRS, there's these RMD tables that you determine how much you need to take out of your IRA, your pre-tax assets. And for some clients, it's more than they actually need, right? So what does that mean? They're paying more taxes than they actually need to pay. So in an effort of trying to avoid paying these taxes as much as possible, some of our charitably minded clients are implementing what are called qualified charitable distributions. And these can actually start at age 70 and a half. You don't have to wait until 73 or 75. If you're charitably minded and you want to give money to a charity, the most tax efficient way to do it is actually out of your IRA once you turn 70 and a half.
Because it doesn't get included as taxable income.
Exactly right. So if you've
contribution goes to the charity.
Exactly. Yep. So if you've got your required minimum distribution, you may only need half of it to live on, for example. Well, you can maybe take the other half and give it to charities. It counts towards your RMD. You meet that dollar amount that is stipulated. You don't have to pay income taxes, and you can check the box on being charitably minded as well. So it really gives you a lot of flexibility to keep those charitable giving desires going, but also kind of control the income taxes you're paying.
It's so important to look at all these different factors. There's so many moving pieces. It sounds easy when you're talking about the cash flow. I don't know how easy really it might be. I don't know, it really is that easy. But
It's easy.
We
It's
think
not
it's easy because that's what we do,
it's
right?
It's not easy to stomach when you see
Yeah,
the numbers
that's probably the
sometimes.
best way. That's the best thing to say. It's not easy to stomach because it's a little bit of, hey, I didn't really realize we were spending that much. And that's an effective tool, right? So, I mean, nobody likes to do it. Like Jake and I said, it's kind of like a confession thing. And we're hoping that when, both spouses are in the room, that they've actually communicated to each other what those look like. So when you're coordinating all these different income streams, right? When you're looking at where they're coming from, when you're going to take them, right? This is all a part of a major complex process that you go through every single year. It's something that you always have to be looking at and you have to revisit. It's not just a one-timer and then you're done. And all that coordination, all that monitoring, really, when you're looking at these different income streams, is the process that you follow to really bring life and finances together.
Thanks so much for watching, for listening, and for learning about income and retirement with us today. For questions about our financial services or finances in general, please check out our website, that's reinveldsdavid.com. Send us an email, give us a call, and of course, please like and subscribe to our podcast and stay tuned for our next episode.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.